Parag bhai, very good afternoon to you. You know, Hiro was just mentioning as to the timelines of this Vedanta demerger, and this is the third time that the hearing is deferred. The last update that we had was on, the NCLAT saying that NCLT ordered rejecting the demerger of TSPL and post cases for the hearing on 4th of August. But since then, we are hearing only deferment of the cases. Your view with regards to how investors should react right now to this?
Sorry, I think I will not be able to give you a view on Vedanta because we don't hold it in our portfolio.
No worries. Parag bhai, your view on PSU Banks. We've seen a stunning rally in all of these counters. Your preferred pick there?
So basically, as we have discussed earlier, SBI, PNB and BOB are the PSU banks which we hold in the portfolio. We remain constructive. In fact, our channel check suggests that this quarter, PSU banks might surprise with a very, very minimal NIM compression, decent growth, and as usual, asset quality will hold on very strong. Although there is a good rally which has happened last 5-6 days and it is continuing today, so we are not chasing it today, to be very frank. But we would like to hold on because we see a long-term structural rally in PSU banks. And just to add to that, even in, as I had highlighted in my last interview, that up till now, after the GST cut, only auto sector and auto component sector had seen a massive run. And now the market it was high time that market should shift to second order thinking, which is financials. And within financials, I also remain extremely positive structurally from long-term perspective on HDFC Bank, which is our very large holding, because of the fact that now that CD ratio is below 96%, market is flushed with liquidity, with CRR cuts. HDFC Bank is best positioned to gain after the GST cut led demand surge, which will happen after 22nd September. HDFC Bank is present in every nook and corner of the country. They have a huge number of branches in tier 2, tier 3 towns and rural areas also, and in all auto dealerships. So I would say that HDFC Bank is all set to grow at industry rate in FY26 and above industry rate in FY27. Stock is just trading at 15 PE on FY27 and only 2 times price to book, which is historical low. And now all the problems of CD ratio being high, liquidity being too tight in the system, deposits not coming to the bank, to all the banks, I would say. All those problems are behind, and now the big positive turnaround is in the making.
So Parag bhai, would you say HDFC Bank would be your top pick in terms of where the private banks go?
Absolutely. HDFC Bank is
we'll revisit the banks again, but it's time for a quick segment where we have the stock of the day, which is MCX. In fact, the commodity exchange, if you see the stock chart, has made some smart moves after SEBI Chief Tuin Kanta Pandey hinted at allowing banks FPI in commodity trade. Varsha is here with more on that. Varsha, over to you.
Well, thank you so much for that. So yes, SEBI is actually widening the participation when it comes to commodities market, and that's the reason, you know, SEBI chairman said that they are considering to allow banks, FPIs and pension funds to, you know, trade commodities. Now, this will lead to a good higher liquidity and higher volumes, and MCX would be the, will actually support this MCX long-term growth. Now, you know, talking about what does existing regulations say, banks and pension funds are not allowed as of now, you know, to participate in commodities market. When it comes to FPIs, they are restricted to cash settled non-agriculture derivatives only. When it comes to mutual fund, they are allowed, but with they do have limitations when it comes to their specific investment. And you know, now these are the current existing rules that we have. Now, what does the new regulation mean for banks? They'll be able to hedge their commodity loan portfolios. You know, when it comes to pension funds, they can actually diversify for risk management, and this opens a new asset class for them. When it comes to FPIs, they'll be allowed to trade in physical settled contracts. And now, considering how this will benefit exchanges as a whole, as I said, there will be more volumes, there will be more transactions and good liquidity, and more volumes will actually, you know, attract new products. There will be new product launches as well, and this will actually improve liquidity, and so there is a vicious cycle, you know, when it comes to these transactions. Lastly, how MCX will benefit. So the current contribution from these segments is negligible, as I said, because they are not allowed. But overall, if you see, FPIs contribute almost 7% to the overall turnover when it comes to MCX. But MCX will benefit because considering the 90% market share that the MCX has. And so this is the reason, because of SEBI is considering the widening participation when it comes to commodities market, MCX is actually gaining when it comes to trade today.
Thanks, Varsha, for that. In fact, with the MCX, Mahima, from a CDSL, BSE, all of them are seeing a good run. And the capital market play probably is the one which is gaining traction over the last couple of trading sessions as well.
And probably that is on the expectations that markets from here on will just see momentum and low downfall. And hopefully that is what we see going forward as well. But Kush, quickly, your view on the charts for MCX?
Not so encouraging. MCX has been on my short call, short candidate list for some time now. We did initiate a call. The stock has underperformed for some time now. If the team could just pull up a 3-month chart of MCX, you'll very clearly see that the peaks actually make it. There you go, fabulous. You can very clearly, without even a proper technical indicator, you could see a falling trend line resistance. The 8,000 mark is proving to be a bit of a stiff resistance. The high today also around the 8,035 mark, and then profit booking from there suggests that near-term pressures could prevail. Call option right up also at that 8,000 level. If, however, in the coming days, if it is able to close above that 8,000 mark, I won't be surprised to see a spring up to another 3 to 5% move. So 8,250, 8,450 could be on the cards. But don't preempt that. There has been some selling pressure on MCX. Wait for a convincing close above the 8,000 level, and then perhaps you could initiate a trade. Not now.
Okay, that's regards to MCX. Parag bhai, how are you looking at the capital market play and the commentary that we've been hearing from SEBI chairperson with regards to expanding, the pool when it comes to investments in commodities, and to increasing the compliance as well? Would you be a buyer?
No, basically, I will not chase the momentum at this moment. Of course, if the banks are allowed to trade in commodities through this MCX and other exchanges, it is a big positive because that will increase the volumes. And it's a great business to be in, but the stock has also rallied a lot. And as Kush said, that this is not a right time to chase the momentum. And of course, all capital market stocks will do well definitely when market outlook is good, right? And market outlook has improved after the communication between US and India has improved. And of course, which should have improved significantly after GST cut, which it has. So I would say that I'm not a big believer of capital market stocks anyways. So I'll not chase the momentum.
Parag, you were talking about HDFC Bank, and there was a Jeffries note also that had come in today with a target price of 1,200. They're also saying the same thing, right? Asset quality is stable, it's improving, loan growth guidance also stays. To take your point ahead further, what makes you constructive or bullish on that particular counter, HDFC Bank?
See, I'll tell you one good thing about HDFC Bank is that they've always maintained top class asset quality across the cycle. If you see 2007-8 cycle of where many other banks and financials lended to power plants without coal and lended to many other real estate players, and all actually became NPAs. So across the cycle, they have kept away themselves from any euphoria, and they have not chased high-yielding loans at the cost of asset quality. That is the DNA of the bank, which I love the most. The bank had I would say last 2 years of a little bit of tough time because when they wanted deposits, there was a tightening and there was a liquidity deficit in the system. Now all those things have faded away. Now they have a CD ratio which is under control, which is below 96%. And banking system is flush with funds due to CRR cuts, which are rightly done by the RBI. So I would say the stage is set. And I'm not saying from Q2 perspective, please be aware. And I would like to say to all your viewers also, this is a long-term structural high-quality bet at a very, very reasonable valuation. And stock has not done anything great in the last 3-4 years because of these issues, which were actually not created by them. Actually, when the merger was done, they had to bring down CD ratio from 110%. So they are not growing. And liquidity was also absolutely tight. So now that CD ratio is in favor, liquidity is good, GST has been cut. So from Q3 onwards, I see them firing on all cylinders with top class asset quality. and valuations are very, very compelling. Where do you see PEG of 1 in the market? HDFC Bank right now, next year EPS is around 57 rupees. And
Correct.
if you reduce the subsidiary value, it's trading at exact 15 times. It can grow at 13-14% from next year. So
Understood.
PEG of 1.
So I think a compelling bet coming in for a HDFC Bank. Very quickly, how are you seeing a SBI if you have to pick a HDFC versus a SBI?
So I have both. I like both. From near-term perspective, definitely there are more triggers in SBI. See, today they got this 8,800 crore from Yes Bank stake sale. They have already raised 25,000 crore from QIP. Their margins will be more resilient this time. The growth will be more. They have got huge value in their subsidiaries. So it's a large weight for us. And I would say that it continues to be. But after such a massive rally, as you know, I am not a buyer in this kind of momentum. While HDFC Bank has not shown any momentum, and I am seeing because the Q2 might be the last quarter of slow growth plus some margin contraction, so people are staying away from it. So that is where I will buy today.
Right.
And from Q3, I feel HDFC Bank will start performing in a big way.
Okay. All right. The other pack of stocks that is in focus is the textile companies. Now, PM Narendra Modi lays foundation stone of Mitra Park in Madhya Pradesh. Textile companies have remained focused on the back of that, and we're seeing gains in a lot of these counters that will be participating in the event. And Jasmeet is joining us to give us all those details as to why is this important for textile companies. Jasmeet, what are you picking up?
Well, right, yes, thank you for that. Now, as you rightly said, this PM Mitra Park is a proposal of 23,000 crores and spread across 91 odd companies. Initially, 114 companies, but now we have 91 companies contributing towards it. We also have a couple of major listed players of textile who have contributed the land and the money for this particular project. Now, if you see Vardhaman Textile, they have invested 2,000 crores for a land worth 190 acres. And on the other hand, we have Trident, which has invested 4,800 crores for a land worth 180 acres. Now, what is this park and how will this benefit textile industry in large? While this park would help textile industry to go and modernize their techniques and reach global level, given the recent tariff impact, they would want to invest and push textile to reach major countries so that the entire risk is diluted. Now, well, this will also help them create major jobs. So the initial direct jobs are 1 lakh per park, while if you look at indirect jobs, they will give employment to 2 lakh plus people going forward. Now, if you look at the other set of news and which would help you understand why the textile stocks are in focus, well, this comes in after the India-US have started their negotiation for trade tariff again. Now, initially after the 50% tariff, they had impacted majorly textile stocks, given that major textile players import a lot of their items to US. And 50% tariff, they would again get strangled by the competition and would not be able to proceed as prior. So that's the reason why the stocks are buzzing, given the negotiation talks are in progress. So it's something to watch out for how the negotiation turns out and how these stocks get focused in again.
Lots of news and lots of buzz around textile companies as well from here on. In fact, Kush, any charts that tell you where you would see further momentum from here on and which could be buy recommendations?
So two stocks stand out. A lot of them have done well in the last 15 odd sessions, but two stocks that stand out even today. One of them is Wellspun Living. Good moves on this one, very healthy volumes, key resistance levels of the past 5 sessions taken out. I think further upsides to about 135 and about 143 cannot be ruled out. Supports near 122 to 120 zone, so risk reward ratio still fairly favorable. And the second one is GoKex, Gokul Das Exports. Here too, very similar structure. Near-term resistance is taken out, 50-day moving average being cleared on the back of very strong volumes today. There is a gap on the upside near the 890 mark that could perhaps come into play for with the kind of run that the stock is seeing currently. So that will be your target. And on the downside, you can keep a stop loss near the 790 mark. So here too, fairly favorable risk reward ratio. So Gokul Das Exports and Wellspun Living, these two stand out. A couple of other names also, but they're seeing resistances. So we'd perhaps skip that discussion for now.
Parag bhai, anything that you are liking in this space? Because on one side, UK FTA was positive. There is EU FTA also under negotiations, but US tariff still remains as an overhang. But India has high aims when it comes to textile exports. $100 billion is something that they're expecting by 2030. Anything in the space that you're liking?
So basically, see, I'll tell you, the communication between India and US has definitely improved, and I am also hoping that this tariff is reduced as soon as possible, because that will prevent many job losses also in jewelry and textile segment. But I would say that I don't want to take such a bold call right now after a rally that it is going to happen in a very short term. So I would like for correction. I would like, but of course, the stocks which Kush mentioned, of course, those are in my radar also. Whether it is Welspun Living or Gopaldas Exports or Vardhman Textiles or Lakshmi Machine, these are the stocks which are under my radar and which I would like to buy on dips. But definitely after such a say market nowadays moves on narratives, right? So market has taken a narrative that tariff is going to be reduced for sure. But I would like to see more clarity on it. And just to be on the safer side, right now, I would like to buy financials. Like, for example, City Union Bank is a bank which is perceived to be a textile lender or MSME lender. But our channel check suggests that there is very, very limited exposure. They are doing extremely well, 15% growth, 1.5% ROA, PE is just 10x. So I would like to bet on such names which are perceived to be, having problem, while actually there is no problem. So I would say that something like those names are, or for example, in a capital goods, as we mentioned last time, a stock like LG Equipment, which has 25% exports to US, and that stock has corrected 25-30%. Excellent quality promoter, debt-free balance sheet, high ROC business, and across the cycle delivered fantastic ROCs. And so I would like to say that I would like to buy City Union Bank or LG Equipments of the world, even if this tariff is about to reduce.
Right.
Yeah.
Right. So that's with regards to banks. But thank you, Parag Bhai, so much for joining us on the show and getting your views.